Let's talk markets now with Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, great to have you with us.
Thanks for having me on.
You make the point in the notes that I've seen that the consumer households are actually pretty well off, and I'm just wondering how you view Target's results through that prism. Does that make you rethink at all, or is this sort of a very Target-specific story in your view?
I think it's a fairly specific story to Target. Now, what we're seeing from this earnings season, and not just actually just on the kind of this consumer space, and actually looking broadly across the sector or across the economy, the thing that you're hearing is that everyone is quite pleased with the way the performance has gone this quarter. It's been a little bit better than expected. But still, CEOs are still concerned about what comes forward, what's coming next, and are worried that a lot of the problems for consumers are only just starting to build up. So we are expecting that, yes, today consumers are resilient, and you can certainly see that with this extra savings cushion that we've been, of course, talking about for quite a while now. But the pricing pressures are starting to build. And certainly by the end of this year, into 2024, we are expecting a lot of those headwinds to start building up and for consumers to almost lead the way into a much weaker economic scenario.
So much weaker meaning what? I mean, most of Wall Street has moved to soft landing. Was that too premature?
I think it is a little bit premature. I mean, I do understand why, when you look at a lot of the economic data today, but I think it is, in a way, fooling people into believing that this could be a soft landing. Now, from our perspective, we are still anticipating a recession starting in early 2024, but we are also expecting it to be a very mild one. Now, on the household side, yes, savings are going to be, I think, exhausted by the end of this year. So as I said, those headwinds are building. But at the same time, corporates continue to look fairly strong. The maturity wall is further away. It's not something that corporates need to deal with. And plus, balance sheets are quite healthy. So they're kind of offsetting each other a little bit, which means that this recession that we're anticipating it's a two-quarter move. It's a 1.5% drop annualized. So you can say about a 0.3, 0.4% move down in growth, which is, of course, by historical standards, extremely short and extremely shallow.
All right. So what does this all mean for the S&P 500? Are we starting to see those cracks now? We saw 1% declines across the board on the major indices yesterday, and that was precipitated by that spike in rates we had in the 10-year yield going to 4.264%. And it does seem like whenever we have that spike in yields on the 10-year, we do see the commensurate sort of drop in the equity side.
Yeah, I don't think that this move in yields is going to be sustained for too long. I think that economic growth picture starts to push down push down bond yields. Now, for the equity market, it is vulnerable. We can see the valuations are very extended. So there is vulnerability to some bit of a pullback. But we're not expecting anything like a 10 to 15% drop. We're not going to go back to last year's October lows by any means. So for investors, when they're thinking about the equity market, any drop that we see could be very short, could be very shallow. So it's going to be very difficult to time that trough. So in a way, we do think that you should still be invested in equity markets, pick very wisely, but also be diversified. So really still thinking about fixed income, still thinking about alternatives. It is a very, very uncertain backdrop at the moment. The outlook is even more uncertain. So this does mean that investors have to pick fairly wisely, and that does mean that diversification is really key.
What leads that short, sharp decline on equities? I mean, we've seen Apple and Microsoft challenge their 200-day moving average to the downside. Is it big cap technology or elsewhere?
So big cap technology, it is a concern because valuations are extraordinarily frothy. But they do have a very strong secular story. So maybe they do potentially drive a bit of a pullback, but we think those would be very quick to bounce back. Overall, though, I think it's just that the economic data is going to start to really wear people down. We think that, plus the idea that even though economic growth is slowing, the Fed is still going to be keeping rates on hold at this very elevated level for a prolonged period. We think that's going to be the key message coming out from the minutes today, from Jackson Hole, and of course from the meetings going forward. So those two things together probably take out a little bit of juice from the equity market and drive that pullback.